Hi, I'm Walter Hamilton, a financial reporter at the LA Times. I'm here today with my colleague Tom Petruno, and we're here to talk about what's been happening in the financial markets. We just finished the first half of the year, and quite a half it was. Stock market, despite a fall in the late June, had a tremendous double-digit gain in the first half. The situation wasn't nearly as bright for bonds. Bonds have been a leading light of the market for the last several years. They weren't in the first half of the year, and we're here to try to make sense of that a little bit. Tom, give us a sense of what happened in the first half, what the outlook is for all of those viewers who are at home wondering, what am I going to do with my bonds right now?
Right. Well, everything was sailing along until about mid-May, and that's when the Federal Reserve began to signal that this huge amount of stimulus they've been pumping into the financial system over the last 4 years may be coming to an end, slowly. They did not say they're going to suddenly take the money away. They did not signal that they're going to start raising short-term interest rates. What they said is eventually, if the economy keeps getting better, we're going to take some of the stimulus away. What that means, since they've been buying $85 billion a month in Treasury and mortgage bonds, is people start to think, well, without them buying bonds, suddenly do interest rates spike up? So the market always does the same thing. It tries to get ahead of where it thinks the Fed's going to be. Hence, you had this jump in interest rates as people began selling. Some people began selling bonds. Market interest rates jump. So not a good first half of the bond market. Let's put it this way. S&P 500 stocks up about 12.6% in the first half. Nobody could be unhappy with that. If you were in the PIMCO Total Return Bond Fund, the world's biggest bond fund, you lost 3% in the first half. That's after whatever interest income you earned, the value of your bonds fell, you had a net loss of 3%, at least on paper.
Right. Now let's help. A lot of people don't actually know what they own. A lot of people are in what are called target date or life cycle funds now, where the fund manager, him or herself, decides what allocation, your X% bonds, X% stocks. For people like that who might not know, what do I own in bonds, what do I own in stocks, I'm in these amorphous funds, what should they know and what should they think about as they try to make sense of this?
Well, number one, you can't be on autopilot anymore with this, and it's been easy since 2008, since the crash, to just be in bonds, pour money into bonds. Interest rates continue to decline, so what you had was you were earning your interest income and the value of your bonds was rising, right? You can't be on autopilot anymore. You've got to really look here at what you own. You're going to have to go in and look at, for example, if you're in a target date fund, what the percentage of that fund is in bonds, what percentage is in stocks, and decide if you're happy with that. If, for example, you were in the target date fund maturing in, I say maturing, but 2015, that's largely a bond fund because it's designed to be less volatile and more conservative. So the 2015 target date fund, according to Morningstar, on average gained just 2.1% of the first half. Why? The stock portion of that fund was up, but the bond portion was bigger, and that held the return down. If you were in the 2051 target date fund, you were up 7.6% on average in the half. Why? Most of that money is in stocks. A minority of it is in bonds. So the bonds didn't hold the equity part back. So you're going to have to get off autopilot and actually look at what you own in these funds and decide if that's still for you.
And what are some of the 2 or 3 perhaps simple things that people should think about? If they're in a bond fund, they've been in perhaps for a while, it depends on their age, their life circumstance, et cetera, but how does a person analyze this? What are the general things they should keep in mind?
Well, that's a very good question. Number one, don't make rash decisions. You don't have to sell all your bonds right now. The Fed has not signaled they're going to be actually raising interest rates anytime soon on the short end, right? So you don't have to panic. The bond market had a conniption there in June. It has calmed down a bit, but there's no reason to make a rash decision. You really need to study this and look at what you have and decide what you want to do. Secondly, why are you in bonds in the first place? If you're there because you like the idea that in general bonds are never as volatile as stocks, right? So the risk of losing 30% in 6 months is still real in the stock market. That could happen. Likelihood of losing 30% in bonds in 6 months, very unlikely, right? So if you're in bonds mainly to guard against volatility, you may in fact want to stay there or stay more heavily there than otherwise. Third, if you're in bonds for the income they generate, which is what a lot of people, at least in theory, were after, you're still earning interest on your bonds. The value of those bonds may decline, but you're still having that interest coming. You're always getting some kind of return off the bonds, and that's important to think about too, especially for older people. Fourth, if you're just wondering about selling your bonds, saying instead of shifting into stocks, shifting into cash. Well, let's think about it. At the bank, you're still earning near zero in short-term bank accounts or in money market funds, right? That's not going to change anytime soon because the Fed has indicated it's not in any hurry to raise short-term rates. So going to cash, as we say, is going to mean a zero return. If you want to do that, fine, your principal will sit there, but you're losing money after inflation. Overall, I just think it's, again, you got to go off autopilot. You're going to have to look at this. A lot of people just can't figure out bonds. It's too confusing to them. The easiest thing to do, if you're in a target date fund that, let's say, is 2020, and you decide you want fewer bonds in your portfolio, more stocks, you would shift out to, say, 2040 or 2050. That'd be the easiest thing for someone in a 401k to do. But you should just really think about it and look at it and realize you've got time to make these decisions.
And finally, as we wrap up here, are there any other types of bond investments, short-term bonds, emerging market bonds, although those have been hit too, any other categories that people might want to think about getting into?
Right. Well, that's going to become, I think, the real key to the bond market, out the next couple of years is bonds aren't all the same, just like stocks aren't all the same. For example, what we call corporate junk bonds often trade more like the stock market. If the economy is getting better and the stock market's going up, you wouldn't expect junk bonds to suddenly lose half their value. I mean, they should actually be helped by an improving economy. Government bonds, treasury bonds, are probably the most vulnerable just because those yields are the lowest. And emerging market bonds, as you know, it's sold off in the first half of the year. Yields may be getting up to a point now where people may want to look at them. But off autopilot, think about what you own, and you're going to have to just differentiate really your fixed income bond investments now, looking out the next few years. There's not a rising tide anymore of falling rates to lift all boats.
Okay. All right, well, we will keep an eye on it here at the LA Times. We will keep an eye on it here at the LA Times. And you got to tell me if you're going to do that. You're like,
No, we always end it.
I'm sorry, I didn't even remember that. I'm sorry, do we now have to do the whole damn thing again?
We're just going to copy right on you, thank him, and then come to this camera and finish it off that way.
Okay. You got to tell me at the beginning. I'm like, I didn't know what the hell you're doing. I thought you're having an attack or something. Okay, you got to remind me. I'm not that much of a veteran that I'm going to remember to do this. All right, so I'm saying, let's get the laughter out. So I'm saying thank you to Tom, and then I'm turning to this camera. Both of us are turning to this camera. Tom was just as guilty as I was.
Okay.
Hold on. Okay. All right, so I'm saying thank you, and then I'm turning to this camera. Okay. All right, good advice. Thank you, Tom. All right, well, we here at the LA Times will be keeping an eye out for it. It'll be quite a second half. A lot of volatility expected in both the stock and bond markets. We'll keep you up to date as things go on. I'm Walter Hamilton, Tom Petruno for the LA Times.